Hello, everyone, and welcome to Saxo Investing Sessions. My name is Ida Johannesson. I'm head of commercial ESG. Thank you for joining us today for this webinar, Navigating Commodity Markets Amid Geopolitical Tensions. I am joined by Ole Hansen, who is Saxo's head of commodity strategy. Let me just share my screen. Here we go, and let's go to Ole's biography. Ole, can you please just confirm that you can see my screen now? All right. So Ole has been with Saxo since 2008, which is about 17, 18 years ago. He also worked 20 years in London previously. Ole is the author of Saxo Weekly Commodity Updates. He's a regular contributor and frequent guest on major TV networks and financial publications. Ole's focuses on delivering strategies and analysis of the global commodity markets. So clearly a highly experienced professional, so I'm sure we are in good hands today. Here is today's agenda. It is wild out there. The year started with a bang, with the US. The year started with a bang with the US operation in Venezuela. And I cannot think of anyone else than Ole to help us make sense of all of this. So Ole will explore the geopolitical landscape and risk factors, the energy market and oil outlook, precious and industrial metals, and he would also have a brief focus on agriculture. We have about 15 minutes for Q&A at the end. Feel free to type in your questions in the chat anytime. I might funnel them to Ole during the presentation, or we might wait till the end. The webinar is recorded and will be available on the platform and the website tomorrow. And the slides are also available for download in the room. Now, before we get going, some important disclaimer. Today's webinar is for educational and informational purposes only and not a recommendation to buy or sell any securities. Investing in financial products involve risk, including the risk of loss. Past performance is no guarantee. And before investing, you should consider your investment objectives, time horizon, and risk appetite. So here, Ole, the floor is yours.
Thank you very much, Ida. And okay, I just need to unmute as well. Thank you very much, Ida. And thank you everyone for taking the time in these very, very busy times, because it's, as Ida said, there's really a lot going on. So we can see that, especially also in the commodity market, responding to a great deal of uncertainty, both on the geopolitical front and also on the fiscal front. And we've seen some major gains and also losses in the last year. I took this snapshot, as you can see now, yesterday, just highlighting the major performances across what I track the most when it comes to commodities. That's the Bloomberg Commodity Index total return. You can see on the right-hand side, it's up almost 16% in the last 12 months. But also looking at the breakdown, you can see these gains has been generated by a few major gains, especially in metals, and silver is clearly the one that stands out, up 200%, gold up 70%, and we need to address why investors around the world are prepared to give up yields and give up interest rate or give on coupons in order to buy a piece of dead metal that doesn't give you anything apart from the hope that it will be that either it will keep its value if things start to go badly wrong elsewhere, or it will actually generate some price gains over time. And price gains we've had plenty of in the last year, and the big question I'm sure many ask is, where do we go from here? We'll take a look at that. But also a sector like the energy, which now for a couple of years has been on the receiving end of some negativity. We saw some weakness again last year, especially natural gas. We just got to touch base on natural gas because we just had the biggest 3-day jump in 35 years. So just highlighting some of the volatility we are seeing across some of these markets. Just on the right-hand side, just compare with some of the other markets that are popular investments. Looking at the S&P, the Nasdaq, the Russells, the Bloomberg in the last year is actually doing reasonably well, more or less on par with, in some cases, outperforming the major stock markets. And we have to consider when we have had all this AI hype, especially in the US, in the Nasdaq, that the Bloomberg index is actually more or less keeping up with what's been going on in the Nasdaq, despite all these massive gains we've seen. It also highlights the US market how the gains has been really concentrated in a relatively few stocks. At the bottom, the big gainers again last year. As metal prices goes up, then the miners benefits greatly from this because their profitability goes up, and it comes after for a couple of lean years where they've been cutting back. They've been basically making their operations smoother, and now the price is suddenly going up as much as has. They've been able to benefit from that. But this is all looking backward. I'm sure we would like to look forward, and the big question I think we're getting asked on and have to ask ourselves on a regular basis: are we at the beginning of a new so-called super cycle? We have been discussing this for a number of years now. We had a low point back in 2020 during the pandemic. So looking at this graph on the right-hand side, it's a little bit of optimistic to start at that point, but that was the low point in a decade-long sideways period of action. But prior to that, what you can see is commodities can be incredibly boring for an incredibly long time, where we can say trade decades without any major movements in the market, simply because commodities tend to be a market where it's a supply and demand driven, and if you have a balance between the two, then there's no real need for prices to move in other directions. And we've seen that for extended period of time. But when they move, and they move really dramatically. And we saw in my lifetime, we've seen two major cycles. The one back in the 70s into the 80s, which was driven by Bretton Woods and the oil shock with inflation back in the 70s, and then the one that kicked off really in earnest in the beginning of 2000, when China joined the world stage and started buying up commodities at a very rapid pace. We saw some major gains. And we can basically argue, now we're arguing whether we are this current one, it could potentially be one that will drive up prices as well. And we believe there is a risk that it would. The energy or green transition is a major new theme that is requiring a lot of raw materials in order to be successful. And we're also seeing the breakdown in geopolitics, the fragmentation of the world, which basically means you're moving production close to home, and that all requires investments and raw materials in order to succeed. And as I put in there, we've moved from a world just in time. Prior to the pandemic, it was all about just in time. So because the supply chains were great, you could order things and receive delivery within a few days. You didn't really think about any logistical issues there. And the world has woken up to the fact that it is a changed world. So now production is more as just in case. So you want to make sure you have enough to mitigate any periods of disruptions. So the energy transition is one that is receiving a lot of attention, but it's not the only one. There are multiple developments emerging in these years that I would say over time already now, but most likely will continue to support demand for a whole spectrum of different commodities. I mentioned deglobalization already. We can see the defense priorities is changing. A lot of budgets are changing around the world, especially in Europe. So a lot of money will go into defense that is quite raw material heavy. The de-dollarization, which is benefiting investment metals, decarbonization, which is the electrification, the EVs, and leading to rising power consumption, leading to more demand for metals that can conduct this power. Copper is clear winner in that case. The current debasement, which is part of the de-dollarization, worries about the value of money, worry about the debt we have in the world, and the need to seek cover in hard assets that you can't inflate. or you can't inflate away just by issuing more, because it is in relatively tight supply already. I can go on, but just keep all these different drivers in mind. One thing we talked about, I've just mentioned population growth, not what we're witnessing in the Western world, but if you look at the growth engines of the world, which is in Asia, potentially Africa as well, that we still have rising populations, and as income rises, so also does the demand for goods that is required that is being produced and requires commodities. Energy transition it will take decades. It's not a short sprint. It's a long marathon. And during this time, we will continue to see demand continue to rise. And what we have witnessed actually in the last few years, where a lot of renewable energy has gone online, especially in Europe and in China. It's basically just helping to meet the increase in demand. So it's not in any way starting to reverse any demand for traditional based energy, and that is a situation we see likely to continue. And one big challenge is the need for investments, really to make sure we have enough energy, that we have enough copper, and we have enough of all these key materials in the coming years. And that's where we're struggling a bit, because we came out of a decade where investment appetite was relatively low because prices were relatively weak, and there's a lot of catching up to do now. But some of these major projects can easily take many years, so we potentially in some areas already behind the curve. Let's move to a couple of specific commodities, just to give a flavor of what we see and what we think. Let's start off with the energy space. Crude oil is really one that hasn't been going anywhere now for the past year. If anything, it's in a small downward trajectory. We're grappling with ample supply right now. Non-OPEC plus production has been increasing, especially coming from the Americas, Canada, US, Guyana, Brazil, and so on. And Ida mentioned the geopolitical risks. Some potential for increased production from Venezuela, even though that situation is still, we're nowhere near any clarity on that front, and that may easily take years before that start to have an impact. So we see that surplus that we are grappling with right now in the larger scale of things as being a short-term issue weighing on the market, and in the longer term, still basically seeing as long as we have two things that collides. First of all, that a majority of oil wells in the world now have reached their peak and will start to reverse. That basically means that we need to find 4 to 6% of new production every year just to maintain status quo. And if we then on top of that add an expectation that demand growth will continue to rise in the coming years, then it's quite easy to add up how much the level of investment that needs to go in not this year. Well, they need to go in now, but not to mitigate. It will be needed within the next, I would say, couple of years to mitigate these decline rates. And that basically means that the overhanging supply, which we have right now, we see as short term. And you can also argue that we talked about the surplus now for at least 6 months. OPEC Plus has been increasing production, but prices have actually been going nowhere. And my argument is that if the surplus really is as real, and then it should also be felt, and prices should be responding to in terms of much lower prices. The fact we aren't does indicate that the market is not really pricing this glut in, or basically they don't see it to be such a big issue. And we can see that in the forward curves as well in the crude oil market, that the forward curve is not really reflecting any slump in the price.
Ole, you just mentioned ample supply of crude oil. Is that one of the reasons why the U.S. operation in Venezuela did not result in the pop in oil prices? And are there any other reasons that you could explain to us?
Well, Venezuela right now is producing somewhere around 300,000 barrels a day. Potentially, they came from close to 1 million barrels 6 to 9 months ago before heavy sanctions were reduced to export. But the industry is so run down, and it will take billions of dollars of investments over a number of years, and clearly also stability, and I think that's where the big issue lies. There was a meeting recently in the White House with oil executives, and only really one had the guts to stick their neck out, saying, "Well, it's not investable right now." It's probably what most of the others felt as well, because they have the major ones have all suffered a nationalization of their assets, and some have even seen it twice. And in order to go back in, they most certainly need assurances. So initially there was a little bit of weakness in the price, but the quick realization that the oil was not going to flow from Venezuela anytime soon, and perhaps even in the short term, the disruptive nature of the current situation could actually add a little bit of support from weakness in supply. So our view is basically that oil is buying time right now. We are stuck here in a wide $55 to $70 range in Brent. Can we go lower in the short term? Yes, that's a possibility, but I would say that 50 down towards 55 is quite a looks like a decent and solid floor. And as I argue, if the market was in oversupply, we probably would have gone there already, and we haven't. One thing worth keep in mind as well, that the structure of the oil market is basically, we're still in a structure where the spot price is more expensive than prices further out the curve. That's called backwardation. That basically means that if you are a passive long investor in the oil through an ETF, as an example, or you buy the future and roll on a regular basis, if you have the risk management tools for to get involved in the futures market, then you would have experienced in the last year that if you look at the futures price, it's actually down 20%. But your total return, if you had a long position that had been rolling it, you would only have lost 8%, simply because of the structure of the curve. We're going to look at some of these a bit later on, where that's beneficial and where it's also been really having a major negative impact. So long story short, oil markets is buying time right now. Longer term, we need higher price in order to incentivize production. So we're seeing that in the oil majors as well. Even though oil prices are weak, we are starting to see some bidding coming into the oil majors. So there are some investments coming in anticipation that the prices eventually will have to go higher. So this is also our base case on energy. Just a few more slides. One thing I want to highlight is the U.S. production growth. It's tapering off. Low prices, WTI here in the 60s or even down in the 50s, is curbing the appetite for investments, and we potentially could see that the growth continues to stall, and that it will also over time start mitigating the surplus we have right now. In addition, bottom right-hand side, we've seen Saudi Arabia and UAE. They've been increased production as agreed. That basically means when they increase production, their spare capacity comes down, and spare capacity is really what's important when you have a crisis where you suddenly have a major disruption. The lower the spare capacity, the higher the risk premium in the market. So that's also helping to underpin prices. And then generally, EIA is forecasting lower production growth in the coming years, and at that basically means at one point production growth and demand growth will meet, and we'll have and then on top of that, still remember these depletion rates that needs to be met with fresh production. That was crude oil. Then just a quick word on natural gas. It is a, as I put in the text, it is a widowmaker, and the last 3 days has most certainly shown that. Or the last couple of months actually, because we surged above $5 back in November, only to collapse all the way down to $3, and now within 3 days we have rallied 50%. We're trading what are we trading right now? $4.70. So we are approaching that $5 once again. And that's simply because we are at the time of year where weather plays a massive part, and we have I just looked at the weather map over the US. It looks like they've just been hit by a massive cold bomb, which is lasting for quite an extended period of time. So we're going to see a massive jump in gas demand in the US in the coming days, and probably weeks as well, and that will help bring down inventories, and that will help underpin prices. But generally, it is a very difficult market to trade, and it's also looking at the futures market again. If you look at the futures price where it is today compared with a year ago, it's actually up 23%. That sounds very nice, nice return. But if you have held a position, a passive long position in that year, you would actually have lost 22%. And that's again, when you have the opposite curve than Brent, than in gas, where we have a contango. So it's basically almost impossible to make money on a long position unless you get the timing very right. So instead of that, perhaps look towards the producers in the anticipation that that demand will continue to rise for gas in the coming years. Then the producers eventually will also benefit from that, and probably also with the higher prices that comes with increased demand. Let's move to the metals, because that's really where we're seeing a major concentration of investment interest, and have seen that for a long time. For a couple of years, especially into the gold market, but most certainly in the last year, also into silver and also platinum. But let's just start off with gold, which no matter where you put it, it is the ultimate safe haven. The others are benefiting as well from tight supply and robust demand, but they are both industrial metal dependent, or the industrial demand dependent. That means there is a price level where that demand potentially could start to get hurt. That is not the case in gold, where it's mostly used as a monetary metal. It's bought for storage and for safekeeping, and that demand seems to be undeterred. Why is gold so popular at this point in time in our history? Well, it's basically, as I write here on the right-hand side, it's not linked to any country's creditworthiness. It's a hedge against debasement worries. Basically, I think I read at one point that the $100 in 2009 is the buying power of that $100 down to $1. So the dollar has basically lost 99% of its value in the last 100 years, and since in that period of time, gold has actually managed to maintain its buying power, and which has accelerated in the last couple of years. So what can change the outlook? Really, only if we see the world start to behave a bit more normal, and that's both on the geopolitical front, it's on the fiscal debt front, it's on numerous areas. It's on the dollar, whether that start to stop falling. Some of them will eventually start to add some headwind to gold, but the big ones, the fiscal debt concerns and the geopolitical landscape, there's not really any outlook that that's going to see any improvement anytime soon, and that basically means investors are still increasing adding some hard assets to their portfolios, and gold has been a major beneficiary of that. Central bank demand looks robust. We just had Polish central bank. It's been one of the big buyers this year, out saying they want to buy another 150 tons, and that's just adding to that underlying support that gold has experienced now since 22, when Russia suddenly had their assets frozen after they invaded Ukraine. Two major things. I see you got a question coming up.
Yes, Ole, and here I'm going to paraphrase you. You mentioned gold is the ultimate safe haven. You also talked about the demand is undeterred, but is there a limit to how far it can go? And what are signs that we are approaching those limits?
Well, the limit is there's not really a limit in a market which is basically determined where there's not it's not an industrial metal, so there's not a limit where suddenly a certain group of investors or buyers stop buying it because they become unprofitable in what they do if gold was the input. That's not the case. It is an investment metal. It is a monetary metal being stored by central banks. It is a metal that has been hoarded around the world, especially in China, where we don't have data that really tells us how much they do hold. But gold going into China rarely leaves China. They have export restrictions in place, and that just means that the market continues to tighten. So unless we find some massive new discoveries that can flood the market with gold, then it's difficult to put a number to where how far and how high we can go. Just looking at from how far we've gone in the last couple of years, it's difficult to say. Right now, the market is focusing. Will you turn your mic off, please? We've seen a lot of talk about the This needs to get, yeah. We've seen a lot of talk about 5,000, and that is also the target I have. But that was for the second half. It looks like right now that target is more for the first half. Let me just highlight two major developments that really has been, if you go back to the slide, that has been impacting prices in the last couple of years. First of all, the very, very long-term correlation between real yields and gold that has utterly broken down, and we can see how that broke down in 2022 when Russia invaded Ukraine, and we also had the galloping inflation following the pandemic, which saw central banks step on the brakes, starting to raise rates. In such a period of time, gold should have suffered if it was anything, if any correlations were still normal. But at the same time, we had the Russian invasion of Ukraine, which basically led to a lot of central bank buying. So for a year, we had a tug of war between central banks buying and investors in the West selling. You can see that on the right-hand side. The blue line is the total holdings in ETFs. And we actually saw quite aggressive selling from 22 all the way to the bottom in early 2024. Throughout that period, investors in the West were selling out because the rates were going up. So basically, gold should not be in the portfolio. Now, the funding cost was too high for them to hold it. But at the same time, central banks and investors increasingly in the East were buying gold. They were not as interest rate sensitive as traditional investors in the West. And that led to the point where basically when they finally started to get back into the gold market, that was when rates started to show signs of being cut again back in 2024. We actually saw last year that more gold were bought in a single year than there was sold in the previous 3 years. And that shows the dynamics that the West investors in the West has really been playing catch up, and I think they're still doing that because of these correlations are no longer working because there are other drivers that adds underlying demand to the gold market. So really worth to keep an eye on. I used to follow real yields very closely because it gave me a good idea about where gold was heading. But as you can see on this chart, clearly that is not the main driver anymore. Just showing a few correlations here as well. We got gold, the highlighted area. We've seen this big rally since 23. I put in the Japanese government bond yield, which is yesterday just spiked to a multi-decade high, which if it wasn't a record, it really has been on a tear. And that is important because if rates in Japan goes up, then the pool of liquidity that has basically been providing an engine to investments in the West for the rest of the world for the last 2 decades, that is starting to disappear. And that could lead to investors in Japan starting to pull their money back home, strengthening the yen, and reducing the liquidity pool across the world, raising concerns about other assets, and that is especially the debt situation, because who's going to fund the debt, and that's also why there's a parallel to gold as a hedge against this. And then we unfortunately got the defense or the geopolitical situation. I put in the highlight the blue, an ETF that tracks primarily European defense companies, and you can see how that's been tracking as well. So just two major developments that's worth keeping an eye on, because they do have an impact on demand for gold at this point in time. Moving on to silver and platinum, because that's really where it starts to get very interesting and also a bit scary, I would say. Let's start with silver first of all, because what happened last year was the year was basically broken into three sections. You had a first 4 months where gold was in the driving seat. Then you had a few months where platinum was in the driving seat, and then you had silver basically picking up the baton and doing the heavy lifting for the remainder of the year, with the other markets then catching up or try to catch up. Silver enjoyed at that time I should have put that in. I don't have it here. I should have put in the gold-silver ratio, because silver was trading increasingly cheap relative to gold, and that basically meant when we had that run up in April last year, investors started to look for alternatives, simply because you had to buy gold at a record to be involved. Instead, you had silver, which was still trading well below its 2011 record, down around the 30 level, and that really helped drive the initial demand. And since then, it really just took off, and I don't think many would have thought that we now would be talking about gold close to $100, but it just shows you how strong that momentum has been. There's been some other developments. I'll just come to that on the next slide. But silver right now is most certainly the overall winner if you look at the last year. But I'm just what I'm starting to get a little bit concerned about are reports, especially from China, that some of the industrial users are starting to balk at these higher prices, especially the solar industry, looking to replace silver with copper, even though it's not perfect. It's still potentially doable simply because the cost of silver input to building a solar panel is now has jumped to the significantly in the last couple of years, making an already under pressure industry from overcapacity even more pressured. So that's one we definitely need to keep an eye on, because we have to remember in normal years silver demand is more or less 60% towards industrial use. No doubt there's a massive amount of speculative interest going into silver. We see and hear about very, very big long positions, but these are not long term. They're enjoying the ride until the music stops. So we can't count on those. Well, we can, but every day there has to be a new buyer in order to bring it even further. So if you are long already, then you at some point you will start to look over your shoulder and look for who the next where the next buyer is going to come from. And if we then start to get some negative news related to demand on the industrial side, then there might be a bit of a struggle. We're seeing that recently in the last week as well. The gold silver ratio has paused after running all the way down to 50, which is the lowest, well below the 25-30 average, which is closer to 70. And we're seeing the gold silver ratio right now trading around 51. So seems like there's a bit of a floor coming into the gold silver ratio. Could indicate that there is a bit of switching going into gold out of silver. But that said, can silver still reach 100? That is most certainly a possibility if this current momentum we've seen recently, if that continues. But I'm just getting a little bit cautious here. And then I have to show probably the most dramatic chart breakout I've seen in my 4 decades dealing with financial markets. I don't recall having ever seen anything as crazy as the one we see in platinum here on the right-hand side. A 17-year downtrend got broken last May when we suddenly started to hear some more bullish news from within the industry. We took out that trend line, and the rest is history, so to say. And since then, we are trading up 146% in the last year. Platinum historically has reached a record high, but relatively to both silver and gold, it's still relatively cheap. Platinum is suffering just like silver from a tight supply outlook, which is underpinning the hard asset appetite that we're seeing, underpinning not only silver, platinum, and gold, but also copper and other metals. And with that in mind, there is a potential for further increases up until the point again where we may reach levels where the industrial demand simply becomes untenable. And the coming months, the big guesswork will really be what kind of level we need to hit for that to happen. But for now, they are probably both, I would say, starting to be a little bit overshaded by gold, simply because, as I said, it is the ultimate safe haven. And right now, with what's happening with Greenland, with Venezuela, with Iran, and so on, then that's really why gold probably is the best, or has been the best performer now in the last few days here. Just want to highlight a few because I'm getting a headache from seeing the following social media when it comes to silver. Ever since I heard about silver futures, I had to trade my first silver future probably, I don't know, 30 years ago. There's always been a lot of conspiracy in the market that has been held down by banks. There's a big short that is just the silver has not been allowed to move in the fashion it should do. My only answer to that is if there really was a big short in a bank and a massive unrealized loss, you would see it in these banks' share prices, and they're basically sitting at the multi-year highs. So just forget about that. And also the so-called bank short, which we can see on a weekly basis in the data from the US CFTC, where they break down the holders of positions. Are shown here the speculative positions, or the positions held by producers, swap dealers, which are the banks, and the buy side, which are speculators. We can see right now swap dealers have been slowly decreasing their position in the last 6 months as prices rose. but also probably as liquidity started to thin out and the underlying and maybe the need for underlying hedges in the cash market dwindle as well. So right now, the biggest risk, I would say, upside risk to silver is not from banks covering short, because that's been very orderly. It's actually from the producers who've been selling silver in order to hedge their production. The problem with that is that requires margin. You need to put up margin to hold a short position, and as margin goes up, as the price goes up, these producers have to continue to add more liquidity into the clearinghouse in order to maintain their position. And as long as they have deep pockets, that's okay. If they don't, then they could be forced to cover their hedges, and that to me is a bigger concern or a bigger reason for a sudden squeeze in the market than the one we see from the banks. One place where demand is strong, that's most certainly over in China. On the right-hand side, the Shanghai over London spread, we can see we are today, which we're back down a little bit, but we are still trading close to $10 premium in Shanghai. These markets are kind of separate. It's two different systems. And silver has been, and when Chinese speculators, they get started, they really get started in a big way. We've seen that in industrial metals as well recently. If this stays as elevated as it is right now, then that will continue to underpin support prices, because that will clearly leave an arbitrage window to import silver into China. Even though you have to pay import duties and taxes, then it will still be a trade that will underpin overall demand for silver. So that's my take. Hard assets remains in demand, but maybe a bit of switching starting to occur as we move to levels where potentially industrial demand could be challenged. And that's really what I'll be watching or focusing on in the coming weeks. I don't see any change in the world, or any changes that warrant profit taking. But we will have very, very bumpy ride. I do worry that we could see a $20 down day in silver at suddenly, because of the how heavy the long position is in the market, and these positions are not people are not married to the position. They will seek a divorce if suddenly the price doesn't dictate it anymore. And depending on where you got involved, if you're trading 95 and you drop to 85, that's probably not a big enough move to trigger. So it has to be something more serious than that. But just keep in mind, still respect the volatility that we have and see in the silver market on a regular basis. I just got another 5-6 minutes left. I will just give you an update on copper as well. It is really as right here at the heart of the global energy transition. We're seeing tightening supply. Miners are struggling to meet the demand. We've had disruptions in the last year. I think I have this on the following slide. Yes, I have. And that's basically led to increased appetite for copper. And when a metal which is purely for industrial use trades up by 1/3 in a year, then you need to take note. Some producers or some consumers right now, especially in China, are starting to have some issues with these very high levels. Does that say that the price will come down? Probably not, but it may mean that we may see a period of consolidation. We also got the Chinese New Year coming up next month, where activity in China slows down for a period of time. But generally, the outlook for the rollout of the EVs, the wind, solar, the grid upgrades to cope with digital data, and the weather, cooling and hot climates, basically means that electrification is an ongoing and something that will continue for years, and that will continue to underpin prices, basically forcing price to be high enough for miners to be incentivized to increase production. But right now, from first discovery to first metal has risen, and now we're talking about 8 to 12 years from you discover copper to you can actually start to extract it, because the political process of getting there is very slow. A lot of copper is needed. I just put in a slide just to indicate how much. If we went to complete EV in the world, we would basically we'll need as much copper as the world's second largest producer, Peru, produces. And I think it's fairly quickly till we can come to a conclusion that that is literally impossible. So there will be a slowdown at some point in the electrification. We're seeing that right now with data centers, and that's also why I'm a little bit concerned about the AI valuations, simply because we're having the old world meeting the new world. And as I put here, the bottleneck is not silicon; it is the copper, the transformers, and the transmission lines. and everything that's related to building and constructing and having enough raw materials available to ensure that all this power can be delivered for all these AI projects and data centers to operate. That right now, that is increasingly a challenge. We also have to remember in the US, recent reports that electricity prices are going up very strongly in areas where we have these data centers. How does that play in a year where where there's a midterm election, where affordability is becoming a very hot potato, even for the current president? That basically means that something's got to give, and ultimately we could see that some of these AI rollouts are being challenged or slowed down, and that basically means that there will be questions asked where all the billions that has come in, whether they're going to come out again in terms of profit. So the old world potentially could be the stumbling block that triggers a reset in this whole AI and data center craze that we witnessed in the last couple of years. In the short term, as mentioned, a lot of speculative interest in China. The Shanghai Futures Exchange opened daily volumes on the right-hand side. You can see it's just simply exploded in the last few weeks. That has now led to curbs on speculation, and that may also just reduce some of the appetite for trading. At the same time, we have inventories very, very elevated, the highest level since 2008. These are just part of the overall inventory picture. These are the inventories that can be monitored by the three major futures exchanges, and they are quite elevated at this point in time, meaning that there is enough supply, but and that again could call for a period of consolidation. But is the overall rally over? Struggle to believe that, simply because of this outlook for demand that we see coming in the coming years. I saw a hand being waved by Ida. Do you have a... Okay. Okay, that's all good. We're moving on. Let's leave copper there. But as I said, if electrification or the green transition or the energy transition is a major driver for commodities in the coming years, then for the commodity sector as a whole, then copper is clearly a key part. Aluminium is another one that also joins this spectre. Rare earths are receiving a lot of attention, not because of its size, but because of its importance. It's a difficult one to trade. You cannot. These are all. There's not really markets that where you can get specific exposure. A few exceptions, like lithium, which can be traded. But generally, when it comes to rare earth, we tend to focus on the producers of the rare earth, and those that are showing promising progress in the coming years. And we can see that here on the 1-year performance. That these performance has just been phenomenal. So these are just some of the suggestions, or not, just examples of companies operating in the rare earth, which also is cobalt and lithium, and some of them are ETFs, which basically gives you a broader exposure. So there are ways of getting exposure. The one that says WT, that's basically Wisdom Tree, which is the ETF provider. It's called Wisdom Tree Strategic Metals, and REM miners. You can see that's up 133% in the last year. So there is a way to gain access to mining companies that will likely benefit from, not because we're only using more rare earth metals, but because we need to move production and mining away from China to reduce our dependency on China. That's why non-Chinese miners will stand to benefit from that change, that geopolitical forced change that we will see in the coming years. Finally, just one word before I just look at speculative data. Just look at the key crops, because they have really been very benign in the last year. That's not where the gains across the sector is coming from, and you can almost say thank God for that. We don't have a food crisis to deal with at the same time. One of the main major staples there is wheat, and you can see wheat is basically just bumping along the lowest level we've seen for the past 6-7 years. And again, the structure of the wheat curve basically mean that the spot price is cheaper than further out, and that means that if you were looking at the futures price in the last year, it's down 8%, but the total return is down 17%. speculators, they like that kind of tailwind if you hold a short position, because they can roll it short and gain this total return, which has been negative 7%. So obviously, if you're short, you would have made 17%, and that is also the reason why wheat has been speculators been holding a net short position since mid 2022, and there's no signs of that disappearing yet. So until we see a significant tightness in the spot market, higher spot prices, then every time we see a rebound, we're likely to see fresh selling, simply because the curve structure um, so benefits those who hold short positions. So it's going to be an interesting battle into 2026. Soybeans have just been through a major roller coaster. We rallied in anticipation that China would step up their buying of soybeans from the US. They did for a little while, but nowhere near the levels that or the quantities that had been expected. And the subsequent collapse, we can see how that also impacts speculators, money managers, the net position, how it just went from a short to a record long, and then utterly collapsed back to square. So speculators are a key driver of some of these movements in the market. But for now, but ultimately fundamentals prevail, and fundamentals right now still points to a well supplied market into the early stages of 2026, and then we need to see how weather developments across the northern hemisphere plays out as we move into the northern hemisphere harvest and growing season. I've talked a lot, but I just want to highlight finally the weekly COT report. What is the COT report? Well, basically, it's a snapshot of how leveraged funds are positioned in the futures market, especially in the U.S. Futures, commodity futures, but also some of the ones that's operated out of London, the ICE futures. Let me just close down my team so it doesn't obstruct us all the time. And why do I look at leverage funds and not banks or producers? Well, I do that because leverage funds they only have one job, and that is to make money. They're not hedgers; they're trying to make money, and that basically means that they will buy into strength and sell into weakness. Normally, the opposite of what a normal or just a mere mortal as you and probably me and probably you as well. That if something has risen very fast, you want to take profit, and if something has fallen, you want to try to catch it. And sometimes you end up catching a falling knife. But leverage funds, they buy into strength, they sell into weakness. That basically means they'll continue to increase their position, either long or short, until the music stops, until there is a change in the technical or the fundamental outlook. And that basically means the COT report and the positioning, both long and short, and the net position gives us a barometer of the health and the state of the speculative interest in a given market. And we actually see that not surprisingly, that it has been relatively low for a while. Even the metals have not really benefited, and because on top of buying into strength and selling into weakness, hedge funds and money managers who are using leverage, they have to target a certain level of positioning or a certain level of volatility. And as the value of the position continues to rally with silver and gold going up, they actually had to reduce their position. So speculators have been net sellers of silver now in the last 6 months, to the extent that they hold the smallest net long in more than a year. So it's not speculators as such that has been the main driver behind the gold rally. It's coming from elsewhere, and I suspect it's a lot of that's coming out of Asia and from the physical market. Just a couple of charts just to show some of the recent developments. Brent crude is favored over WTI. The gold market is reasonably elevated long, but nowhere near where we've been in the past. But we have to remember, obviously, the nominal value is probably higher with that position than it was when we had the peak back in 2024. Copper has been increasingly popular, but also just recently seen a little bit of net selling, simply because the market probably getting a little bit saturated here around the $6 level in high grade. And finally, just a couple of the soft commodities. Sugar is traded from a short position, coffee still from a long. It was one of the better performers last year, and the curve structure still is favoring holding long positions. And that's the reason why that position is relatively sticky. Q&A. I'm not sure whether either if we have anything coming in. I see there is a couple. Just need the mic.
Okay. Yeah, we do have a few questions. I'm just going to go through some of them. Marcus is asking thoughts on rising oil prices impacting cost of other commodities, or is it different this time?
That's very good and very valid question. Absolutely. If the cost of diesel goes up, and then the cost of production goes up as well, and that to a certain extent has to be reflected in the price. So to a certain extent, we can say the whole mining industry has been benefiting from relatively stable to low energy input costs in the last couple of years. But at the same time, labor costs has been rising. Taxes to local governments been rising as well. But generally, if we see high energy price, that will add to the input cost, and that input cost will have to be passed on to the consumer, unless the consumer doesn't want to pay that higher price. But given the outlook for demand we have for some of these energy intensive production industries, then it's most likely that higher energy price would also filter through to higher consumer cost, and again feeding the rally we have seen. So yeah, very valid observation.
All right, we have another question from Nell, who's asking, what is your view on platinum? It is not moving up with gold and silver. Will it finally move up? And what are the drivers for platinum, industrial or precious metals?
It has been a combination of. I'm just going back to the slide because it has been doing, I would say, extremely well. It didn't do well for almost a decade. You can see from 2015 all the way up to middle of May last year. We were basically hovering around $1,000, where we had a lot of activity in some of the other metals, but they have most certainly been catching up. But if you look at on an absolute basis, it is expensive now, but on a relative basis, it's not. So while the industrial demand may start to suffer somewhat at these levels, I think the combination of tightness with supply primarily coming from South Africa, which is gripped with a lot of problems. Also, one of them is being electricity blackouts and so on. Then I think the relative cheapness to the other metals, I would say actually right now, particularly to silver. If you look at the platinum silver ratio, it's 1/3 of what it was in the past 20 years. So platinum is historically very cheap right now compared to silver. Gold is also still relatively cheap. Remember, platinum is trading at right now at 2,500. Gold is trading $2,300 above. A decade ago, platinum was trading above gold. Obviously, platinum is not bought by central banks, so it hasn't got that bid in the market as a gold market has. Central banks would probably never start to buy either silver, platinum, because then they will hurt industrial users, and they'll pump up inflation. So that's not going to happen. But platinum is a very, very small metal, and if the market continues to move higher, especially gold, then investors will be looking for relative value, and they'll probably still find some relative value in a very tight supplied platinum market. So answering the question, what could drive it further, I would say that has to be investment demand, because industrial demand may start to have a few issues with these levels, which on an absolute in absolute terms are record highs.
All right, another question from Vlada, which is a bit of a loaded one. When can we expect a pullback in gold and silver producers?
We can see a pullback in two ways. The one that I think is probably most obvious is if we see continued weakness in the stock market, even though if we see a major correction in the stock market, then some of these some sectors will do better than others, and the mining sector probably will be one of those because of the underlying strength and the underlying profitability we're seeing there. But a stock market correction, mining companies cannot shield themselves. And then if we do get into a situation where it's a question of deleveraging, basically as an investor, you are starting to hurt to the extent that you need to cut your exposure, then you will cut your exposure across the board. You will not cut everything else apart from your mining companies, leaving you extremely exposed just to one particular sector. So if we see a continued or accelerating correction in the stock market, then mining companies, especially those that have been very popular, will suffer not because their fundamentals have suddenly changed, but because there is a deleveraging selling coming across the market. Also, of course, if we do see a significant correction in the actual price of the underlying that they are producing, then that would also trigger a setback. And then when you have something, if you have a metal that's risen 50% and a mining company that's risen 100%, then if we do see a sizable correction, then the correction in the mining company potentially could be even greater because of the higher volatility or the higher volatility relation between the two. So these are the two things we have to look out for. So I think in the short term, stock markets are coming down because of geopolitical worries, about fiscal debt worries. These are playing into the hands of hard assets. So I think that the biggest risk of a correction in the mining company is probably from a deeper correction in the stock market than what we have seen already now, which is, if you look at the Nasdaq, yes, it was a bad day on Tuesday, but just look historically, we're not even at probably not even at levels we saw a month ago. So far the correction, even though it looks a little bit dramatic, receiving a lot of noise, it's not big enough to really trigger anything meaningful. For that to happen, we probably need to see a 1,000 point down day in the Nasdaq or something like that. So that would be my take on that.
Okay, we have time for a few more questions. Tom is asking, it seems like oil prices barely moved after the US operation. What kind of event would be powerful enough to move oil meaningfully?
I think we just have to look at what happened last week when crude oil prices jumped from having been trying to break below 60. We're suddenly trading 10% higher, and that was related to Iran. So a geopolitical event impacting a major oil producer is most certainly in the short term the biggest upside risk in the oil market, because we have ample supply, which then could suddenly be reversed if we do see an impact or see a disruption. Iran is a major player, a major producer, but it's also sitting at the narrowest point of the Strait of Hormuz, where oil from Saudi Arabia, Iran, Kuwait, or Iraq and Kuwait comes through on a daily basis. So that would in a worst case scenario have a significant impact on supply from the region, and that would send prices higher, at least very, very quickly start to eat into the spare capacity that is being talked about. So a geopolitical event in the short term. Longer term, it is the lack of investments going in, simply due to prices right now are not beneficial enough for these investments to really to pick up the pace that is required. I think also it's worth just mention that the whole, I'm just going to remove this, the whole issue about U.S. production and Trump wanting to see lower gasoline price ahead of the midterm election. It is one way you can't have your cake and eat it, simply because low oil prices is already now starting to hurt production in domestic production in the U.S. Harold Hammond, one of the prolific shale oil entrepreneurs and pioneers, he's basically cutting back in some of the areas where he'd been expanding for years. And it's something that's being repeated by the others. So lower oil price from here will eventually lead to lower production, and that cannot be met by any increase from Venezuela, because that potentially could take 5 to 10 years before we get a meaningful increase in production from Venezuela.
All right, I think we have time for one last question, but in the meantime, I'll just share my screen, which has a QR code for our survey. Would greatly appreciate if you could scan this and provide your feedback, as it helps us improve and serve you better. So one last question for you, Ole. It seems like geopolitical tension is more a constant now than an exception. So how is it that investors should navigate commodity markets today?
Well, seeing them as part of a potential hedge against geopolitics and all the worries that we're dealing with, because simply if we are commodities, you cannot inflate away, you cannot issue or suddenly produce more, like you can issue more debt if you need financing. Obviously, issue more debt until the investors are not prepared any longer to back that continued issuance. So I think the commodities generally plays well as a semi hedge against all of these worries, simply because they are They are tight in nature. They are hard assets that you can't inflate away, and it will give you some kind of some sort of protection in these very troubled times. And I think the last year, if anything to go by, has shown that shown the effect to that. Looking ahead, I don't think anyone expects that we can see similar returns in gold and silver this year. So we'll have to see some of the other commodities step up, and that's where potentially we could see energy be a surprise contributor, even though there's still a lot of focus on oversupply, which some of the major banks basically lead them to call for prices to be quite a bit lower than where they are right now. My argument is simply that we should have seen that weakness already if that was the case. So I'll stick my neck out and think I wouldn't be surprised if we see energy prices higher in 6 to 12 months time from now.
All right. It is 1 minute after 2. Thank you very much, Ole, for making the time today. Thank
Thank you.
you to all of you joining us. We hope to see you at upcoming webinars. I'll put the QR code for the survey back, and actually, Happy New Year.